I may or may not have put an alert to remind me when Microsoft got to 250, Coach Matt. So this is now part two. Part two of this conversation of the covered
Part
call is
part of
now.
part two is accountability here.
Part two of this is now candle is gone. I mean, the price has moved and moved, way above 250. So now I'm in the money. There's a ton of intrinsic value. And the queen may or may not have had her, alerts work and let her know to get out of roll the call. So here I am. The question for you now, I got to make a decision. This is not, should I, shouldn't I got to
Nope.
do something. Question is what?
Okay. Last week when we're having the conversation, we're underneath 250. You've sold the 250. There's more extrinsic value in the call option than there is intrinsic value.
Mm-hmm.
The end result of that conversation, which I loved that conversation, by the way, was a suggestion to maintain the call until the extrinsic value gets exceeded by the intrinsic value, and then to either open it up and let it fly or roll it up and out, right?
Yeah.
Or roll it up to a certain extent, right?
Yeah.
That's the conversation. You're now at the stage because of the market response to the Fed last week, and then obviously some continuation this week with the specifically today. You're well in the money. You're well in the money to the point where your extrinsic value is the exact opposite conversation as we were having last week. Remember, last week we're down here in the black, right? You
Uh-huh.
got zero intrinsic value and you got a lot of extrinsic value, and you want to let that bleed out.
Yep.
This week, because of the price response to Microsoft over the last 7 days, you're now right here. You got that 250 strike price with 10 days left. The intrinsic value now is 1656. The extrinsic value is now 91 cents.
Mm-hmm.
That's you're bleeding here,
So
right?
I didn't do any
Now,
of the two choices I had last week, and now I'm like, okay, what's my
now now you're faced with the most difficult decision that covered call traders have to make. And honestly, it's something where it's routine. It's not like it's abnormal to have this decision in covered call mechanics where you're in the money on the call option and you have to make a decision whether or not to open up the risk graph and allow that trade to work out like a swing trade would do. And that's how you would approach it, is you would approach Microsoft like a swing trade, and then you would recover it once you see some technical loss of momentum. The problem with that analysis for the people that don't like to swing trade, they don't like to keep it uncovered. And so yeah, they're going to want to roll. And I do want to get Mark's perspective on this one as well, because our answers may differ here. I'm going to always rely on the technical picture and let the technical picture tell me what the best choice is. And right now, when you're now dealing with a situation where the call option is deep in the money, you have a tremendous amount of intrinsic value here, not a lot of bleed left to occur. Remember, you had like $4 of bleed last week. You now have a dollar. What would it be, about $1.50 of bleed to kind of come out of the market? So you don't have that much to bleed, which means you either one, you got to roll that call, or you got to uncover the stock. You cannot allow it just to, unless you made the choice, just I don't care, let it get taken from me at 250, and that's fine. Just let it go, right? Just let it go to expiration, let it get taken from you at 250, make a decision to rebuy if you want. But then you also have, especially if it's a longer term investment, you have some tax consequences there that you have to consider. And so for me, it's a matter of, do you leave it uncovered and allow the technical momentum to take hold, or do you roll the call option up, or do you roll it up and out? And so that's the conversation you have. And when you're rolling, you're basically buying back the original option at a loss, because again, you sold it for what I'm assuming you sold it for about $5 is what I'm assuming you sold it for. It's now worth, $16, $17. You buy it back at a loss, and you might say, Oh, but we're taking a $1,200 loss on the call. Yeah, you are. You are taking a $1,200 loss on the call, but you just made $2,000 on the stock. It's that type of conversation. And even though when you think about it like that, it's like, yeah, just buy back the call, let it rock. You're going to take a loss on the call, you take the win on the stock. It's not as it's far more difficult mentally to make that decision though.
Mhm.
And so again, it's the hardest decision in cover call mechanics. It's in a management versus a repair conversation because it is aggressively went up in the money. It's not just a matter of rolling it up. You might also want to sell something against it as well to offset the upward movement price, such as a naked put deep out of the money to kind of repair the covered call to a certain extent. Because the market gave you opportunity to make that decision the following day, right? You saw that breakout at 250, and this is where the decision needs to be made. Now, I know
Mhm.
you were gone, right?
Yeah,
You were
I wasn't
gone. You were
here,
gone.
and I
You were
missed the
gone.
alert.
You missed the alert. I get it, but that's the decision. It's when it breaks out of your strike price. It's right here where you make that decision because at this point on this candle, in
Mhm.
extrinsic value versus intrinsic value is basically a wash.
Right.
It's even against one another. Again, you sold the 250. The closing price is 253. That's going to give you $3 of intrinsic value. I do believe we were around $3 of extrinsic value. At that point, you just make the decision to buy back the call and roll it back up and out when you break out at 250. Again, when you're underneath 250, you still got a little bit of room to play with. And again, looking hindsight is really easy on this one because it's like, oh man, Microsoft's in a high base and broke out. No, that was Fed day this day. That was a massive, massive variable. And yes, historically, we look back and we're like, oh, yeah, broke out. Go. I mean, you had some strength. You were on the 90 EMA. No, that's Fed day. That's a zero edge type day. That's a variable that we need to see happen in the market. When we see it, it's past us in the rearview mirror. At that point, you have the opportunity to make the decision. We missed that opportunity. So now we're sitting at here at 266 saying, now we got $16 of intrinsic value. We have basically $1.50, $2 of extrinsic value. You're underwater from a reward to risk ratio perspective right there. So once again, the raw data suggests you have to make a decision. You
Mhm.
want to make a decision when the intrinsic value exceeds the extrinsic value. That's when the decision should be made to roll up and out, to roll up, or just to leave uncovered. So when you're deep in the water, from a cover call perspective, and the extrinsic value far exceeds the extrinsic, you have to make a decision, or you're going to get your stock called out from you. And again, that's not necessarily a terrible thing if you're treating a covered call like a position trade.
Yeah.
If the covered call is a position trade, getting called out is not a bad thing. If the call is if you're covering an investment, you're probably doing a management conversation of rolling up here. And so if it's a position trade where you're like, I don't care if it gets called for me, there is nothing wrong with letting that call option get called out from you, delivering the stock at 250, because when the call option gets exercised, all that premium that it's adjusted over the last week and a half goes to zero. All of a sudden, you're at your max return at expiration if you do get called out. So treating it as a position trade is not necessarily a bad thing. A little bit of a set it and forget it type mentality in covered calls, allowing it to get called out. But once again, for a lot of investors, for a lot of traders who think about a little bit more longer term, that they might be holding Microsoft a little bit longer term, not just I bought it 3 weeks ago and sold it at 250. And I'm not saying that's what you did. I'm just saying hypothetically in that situation, they might
Mhm.
have a little bit more important conversation on a tax perspective as well. And so if you're thinking about Microsoft as an investment longer term, you don't want to necessarily get called from. You either one, you leave it open ended and you buy back that call option at a loss and you wait for the technical momentum to shift on Microsoft. That is a swing trade adjustment that is purely technical in nature and not for newer traders, in my estimation. For the vast majority of cover call writers, the most probably the better adjustment is to roll the call up and maybe even up and out. Mark, what's your thoughts on that?
Cover call management is something I have spent so much time thinking about, right? As a cash flow trader, you have to. And, my rules have evolved over the years. I personally, but once again, I don't have long-term ownership. I'm always constantly renting, sometimes renting for 18 months, right?
Yeah.
Sometimes renting for a long period of time, but I don't know, I don't have the burden, I guess, of like, oh, what if I lose this? And so, first of all, that's my mindset, right? And so for me, I have a rule that I don't personally add cost basis to a trade. And so for me, what I'll do in situations like this is I'll roll it out. I'll look for opportunities on pullbacks to maybe roll it up a little bit at some point. I just hate it is a cardinal rule for me. Now, when I teach, because I know
Can I
not
ask you a
every,
question on that though?
yes, absolutely.
On this specific example,
Mhm.
rolling it out would add time frame, correct?
Yes.
But you would still be rolling the 250 strike if you're not rolling it up
Yeah,
as well, correct?
and there are times like, especially when
This
there's
one's a
zero,
radical example of that, by the way, because you have so much intrinsic value. You're still underwater if you roll it out here.
yeah, and so like rolling it out, I'm picking up credit, right? Like if I rolled it, let's say that's there's a buck left in the thing, but out there in March, I got, pick up another, at the 250, another 250, $260, right? So I am picking up, some theta on the rollout. And then I'm paying close attention to opportunities potentially to nudge it up a strike price, right? Because, if you get a pullback and all of a sudden, well, the theta on the short-term option is going to like be almost nothing, right? But that theta can pick up and you can find these opportunities along the way to not add cost basis to the trade and roll it up and out a strike price. Now, when I teach this, because not everyone's like me, in fact, very few people are like me, right? Very few people are like, no, I won't add cost basis, right? No, stubborn, not going to do it, not going to do it. You got to make this decision before you get in the situation, right? Like when you
that's the real takeaway here is
like
you need to make the decision when the extrinsic value exceeds intrinsic value. That's when the decision should be made.
And so if you know that's who you are, and this is how I teach cover calls, to general audiences, it's like you got to know who you are before the trade management decision is faced. And if you know you're going to roll up and out, great, right? You just got to know when to do it, right? You got to.
And again, I think this is why the importance of the mentality of the trader / investor and their time frame they're attaching to the investment. If you're just treating the covered call like a position trade, there's not a problem getting called out here. There's not a problem with that.
No,
there's nothing wrong with that.
As long as you structured it as a successful trade, hey, it's a win.
No, that is a great job. Even if it's up and you missed out on some opportunity,
and if you're new, exactly. Right? If you're new, you're like, but if I could have, sure.
No,
right?
We don't play that game. We don't play that game.
If you start playing that game, you'll torture yourself. I could have bought Bitcoin at $3.
Yeah, right? I could not have sold Tesla originally at $40 in a covered call. We can all play that game. Hey guys, listen, I invested a ton of money in Bitcoin at $180 and I sold it at $300. Oh my goodness, we don't play that game because
we don't play that game. All right. So
yeah.
So those are some of my thoughts on it.
So my ultimate question to you is, what is Microsoft to you? Is Microsoft something that you have a staple in your long-term portfolio that it is an investment, or is Microsoft in a tradable account that is more current taxable and you're just treating it as a more of a single position type scenario?
It's an investment.
If it's an investment, you probably got to roll here. You probably got to roll or you leave it open-ended. Now, I will tell you right now, Mark's way of managing that would be different than mine, because I would treat it swing traded like. I would take the loss on the call, let it open up a little bit, and let the bull market take care of itself to a certain extent. and let the natural bullish trend in the market take care of a little bit of the loss on the call side. But I'm also very quick to treat it like that technically. Whereas I'm almost certain Mark would suggest constant rolling here until you get that deeper pullback. Would you agree with that, Mark?
Yeah, no, and even if it's punting, like, because you can punt a week and pick up like $20-$25 on a stock like Microsoft, right? It's not much in theta, but it's like I got, I don't want to take the big cost bases, but I want to be more aggressive if I get a pullback to roll. Punting it out a week instead of rolling it out a month where your hands are kind of tied, right? And so like I'm gonna go pick up some token chains, and you're not doing it for the token change. You're doing it so you have the opportunity to make a good decision coming up on a deeper pull.
Well, and can I make one point on that? Because part of the Tackle 25, and Microsoft is a mainstay on the Tackle 25, is the fact that you do have liquidity, you do have weekly options, that and the importance of the weekly options is not necessarily so that you can originate the covered call with a weekly option. It really is beneficial in covered call management to have liquidity in weekly options. A lot of stocks that can be really good covered call stocks, but don't have weekly options, they can still be really good covered call stocks. They just don't allow you the degree of management from a rolling perspective within weeklies that a Microsoft allows, for example. That's a wonderful point there as well. And for those of you that are new to covered calls, one quick point, then we'll turn it to Mark for final thoughts on this conversation. This is a topic every single one of us have struggled with on covered call mechanics.
Oh, goodness, it takes a long time. Yeah.
We call it the toughest decision in all covered call mechanics is when you are in the money on your call option and the intrinsic value has now exceeded the extrinsic value. It forces a tough decision on the trader. And if it's a position style, oftentimes the trader will just say, let the call option work, let it get called out. Let me take max return on the position. If it's an investment, it makes that decision a lot harder. And this is why a lot of covered call writers, they actually prefer sideways to slight downward trends in covered calls because it makes everything easy in covered calls. You want a flat line for 6 consecutive months, covered call writers that's their best environment, quite frankly, because they write, it bleeds. They write, it bleeds. They write, it bleeds. And then the reason covered call writers love that is it doesn't take any thought process. It doesn't take any decision-making process. So the call options above the stock price, you're in some neutrality. Let those call options bleed. When the market has a little bit of kickstart momentum, as we've seen in the last month, and you're seeing some continuation momentum here early on right now, just kind of going on what the technical condition of the market is, these are when it gets tough, is when the covered calls get in the money and it's a long-term investment and you're worried about a tax consequence if it gets called out from you, and it forces the decision to punt. And that punting is to either roll it out and capture more time, and basically with the hope that you'll get some downward pressure in price and alleviate the pressure that call option is putting on that position. Or two, you buy back the call at a loss, you allow Microsoft to open up the risk graph a little bit, and that's swing trading mentality 101. You're treating that like a step system swing trade, which you're immediately going to write it back once you see the very early beginnings of overextended technical resistance or a loss of momentum on the bull side. So it's a tough decision. It's a decision all of us are faced with constantly in covered call mechanics. And so if you're that trader sitting by listening to this conversation and you're saying, oh man, I'm the only one on it, this sucks. I've had to do this. No, we all have had to do that in the covered calls. Again, I've called it the toughest decision in probably all of trading, in my estimation, is what to do with that call option if it gets in the money. And so again, realize you're in good company if you've struggled with making that decision before, because we've all struggled with making that decision before. Personally, because of the momentum of Microsoft, because of the momentum in the marketplace, I would let this resistance play out and a close above 265, I would allow it opened up.
Hey, listen,
Doesn't do
Emily,
that, roll it
by
out.
the way the market is selling off the last 30 minutes, it's gonna be out of the money by the end of the session. So
It's so dumb, those algorithms sometimes.
it is
so
zero data
dumb.
option expiration backfire.
It's so dumb.
And I want to talk to you about this on the podcast today. I want to talk about it is zero data option expiration backfire. I didn't bite, like, while we're here, I didn't bite on this one today. Like,
not yet. No. We're going to see the
I'm going to wait for stabilization. Yeah, exactly. Wait for the slowing down. Because
he's probably not even done talking. Like,
hey, listen, my final thought, Emily, on this is know what your trade management decisions before you write the call, right? And that can take some time, but know what you're going to do ahead of time, right? Makes it a lot easier. You don't want to be put in tough positions, right? You want to be put in a good position.
Later on today, I might have some commentary about my dislike of algorithm responses to economic and technical events.
Matt, let me just we go to the 1 minute or 5 minute chart. What happens in this situation by going up and then not creating support levels?
Every chart. Every chart.
And what you do is you create the momentum necessary to send you even lower. So
can
the
we
extra
ban
moment,
Citadel, Virtue, and Goldman Sachs algorithms? Can we just do that? Can we ban them, please?
The bulls here set the stage for downward
It's not
momentum.
the bulls. It's the algorithm response. It is not a bull versus bear conversation. That's a conversation we people have. That's an algorithm response that was pre-programmed.